this is the educational piece. Step 2 of the 10 steps of successful trading. It's risk and reality of trading. This is very, very, very important. If you like this presentation, you can also tweet it on your Twitter account. If you want a free course to look at during the slow holiday season here, you can go to winningwithalgos.com/start and enjoy the 6 hours video course for you. It's free. So welcome to FibStalker Trading, Simpler Trading for All. And last week we started with our journey to understand what we need to do, what we need to become in order to go from A to B. And we saw that we have to change our belief, behaviors, and routine. If you want to watch that, if you didn't watch that first step, I warmly recommend you watch. It's very, very important. We also learned that trading is not a business. Trading is not a job, it's a business. Trading is absolutely a business. And I also very briefly presented the 7 pillars of trading modern markets, and you can find this open presentation on FS Street as well. And I reminded that everything revolves around trading as a business. We have the mechanics of trading, we have the psychology of the trader, and everything revolves around the fact that we need to treat trading as a business. We fail to do that and we expect an income or a salary from trading, we are going to get into trouble. Ask me why. In the past, that happened to me. So don't just try to make some money, but build skills. That's very, very important. 95% of traders never learn effective skills in trading, and that's one of the reasons, not the only one, but one of the reasons they lose consistently. Now, these are the 10 steps. Last week, we looked at an understanding what it means to actually do and be involved with trading. Step number 1 is understanding the kind of business we got into, and that's very, very important. There are a number of concepts that you have to absolutely you have to understand in detail. Particularly, we also spoke about the truths and principles of trading, and it took me several years to integrate those truths and principles into my own trading, and that's something that there's no way around it. You will need to adapt your trading system, trading method to that as well. All right. Today we're going to focus on risk and reality of trading. So let's get into it. And the only thing I want to do is just activate my pointing here because I want to make sure that that I can annotate charts later on in the second part. All right, so first of all, as I mentioned before, risk management is jobs number 1. If you believe that the job of the trader is to generate high profits, I think I'll simply say you're not on the right path. And the reason is, and sorry, just let me activate this here and share the screen so that I will be able to annotate and put notes on here. And if you believe that it's to generate big profits, that's not the point. The point of trading is managing risk. Case closed. And the reason is, as you will, if you review and remember step number 1, the market's response to a number of truths and principles. If you don't accept those truths and principles, you are trading an idea of the market does not exist. All right. Now, if you want to stick to those truths and principles, risk management becomes your main job. Otherwise, really, you are trading something which is not the markets as we know them. So as a result, I suggest you develop a profound respect for the market and the risk involved in being in the market. And we can always come back and show some of the charts, whereas if you were caught into them, basically your account would be valued zero if you didn't manage this properly. So minimize risk at all times. That's your job. That would means to manage risk actively, proactively, actually. Minimize risk at all times. So never assume anything in the markets. Remember that anything can happen in the markets, and that's the very first truth about the market. Okay, anything can happen. So if anything can happen, you have to plan for the worst case scenario. Minus 20 times your initial risk, minus 50 times. I know it might seem extreme, right? But the way we structure our money management, it's around this kind of extreme behaviors as well. Because of that, always assume you're going to lose also the full dollar risk at every trade. I risk 1%, and in step 5, I will explain you how risking 1% and then using actively money management can help you to get your trading results. You don't have to generate high percentage return. You have to generate small, consistent percentage return, and then we apply money management to increase that. Okay, so always assume every time you put up a trade that you're going to lose. And I know that might be tough to do for the majority of people who do not have the psychology, have not developed yet the psychology of the right beliefs to be in the market. To be in the market, you have to develop the right beliefs. The market does not work based on certainty, based on the rules that regulate our life. The market has its own rules, and you have to understand them. Another very, very important point, to accept the full risk at every trade. Now, the question here is, well, what's my risk? And I can tell you that a lot of people, many more than what I initially believed, do not even have an idea of how much they are risking. How much they are risking? They don't know. They don't know. So if you don't know how much you are risking, and let's say that you trade one lot fixed. I know a lot of people who do this, which doesn't make no sense to actually take a position of one lot, because if your pip risk change, as it should, because the pip risk has to adapt to the current market conditions, then it means that you're getting very, very different amount of risk. Maybe in one trade you're taking 1%, in another you're taking 5%, because your position size is fixed. All right. So if you don't know how much you're risking, you cannot accept your risk, and you're in big trouble. Okay, that's not how the market works. That's not a right belief to trade the market. And keep initial risk low at all times. Steady gains and consistency are more important than large gains on single trades. And I'm going to show you that on step 5. Okay, so trust me for now. Take every opportunity to reduce risk. I have a technique which I call risk-free trading. It's not necessarily a technique that maximizes gains. In fact, it does not maximize gains, but maximizes risk management. And especially when you're starting in trading, and you don't know all the rules, you don't know, you have not developed all the beliefs that you need to function properly in the market, it is important to adopt absolutely, and keep adopting any device and any trick and any tip that can actually help you reducing risk. Only trade low risk opportunities. I always wait for a confirmation. And particularly my trading, I get the backing of multiple players. For example, you have probably heard me talking about smart money and dump money. I want to have both of them, if possible, agreeing on a trade, because that minimizes the risk that my stop is going to be hit. Right. So as you can see, each and every activity item, sub-process of my whole price analysis and trading process kind of tends towards reducing risk. It's all about that. And again, you can reduce risk by adopting techniques like reducing the initial risk, or using risk-free trading, or trying to identify low-risk opportunities that are backed by multiple players. But you can actually build risk management also within the process that you use to select the opportunities, to select the trading system, and to elect one setup to a valid setup that you're going to trade. All right. So if you have any questions, you can write them down. And as usual, I'll be very, very happy to answer them. Next. One other thing that I do, I always assume that I have not seen the worst yet. And mind that I'm very, very positive in nature. I'm a very positive person. I smile all the time. I have very good relationships, and I'm pretty happy, I have to say. But despite that, I got to know the market and what it means to be in the market. So probably we have not seen the worst condition yet, okay? Which means that we need to keep the risk low at all times. 1929, 1987 crashes, the crisis in 2007, 2008, the flash crash in 2010. I don't know if you were there that day. I was there that day. It was very scary, actually. I was not trading, thanks God, and you know, I saw something that impressed me. The Swiss franc in 2015, the more controlled, in a way, event like Brexit, at least you know that they are pre-planned, or the reaction at the US election vote. And, you know, this surprise will be will have a bigger impact. I mean, events that in the past might have been normal will have a bigger impact in modern markets. Why? Because there is a lot of automation, there are a lot of automated agents, and there is high-frequency trading as well, which is very well known to subtract liquidity to the markets exactly when the markets need it, and that generates price swings that were not seen before. That's just one of the events. Of course, there is also higher participations in this market from retail traders, as well as boutique brokerages, banks, and you name it. Okay, so these events are not isolated events. There will be more. Just accept this. If you don't accept this, fine. You do it at your own risk, and that's okay. I mean, after all, it's your money. You can decide, but try to make a smart decision as well when it comes to your future, at least your future as a trader. So if you do not respect the markets and manage risks, this event, make no mistake, will wipe you out. And when the money is gone, the game is over in trading. So there's no other opportunity to start again. You need a life, and you need 10 years and 20 years of savings in order to start again. Okay, so probably, the probability of black swans, so the far left belly in the bell curve here, are definitely underestimated. I'm talking about the far left, the negative tail. In fact, they speak about fatter tails, which means that the probability of negative events is underestimated. So again, I'm not trying to be negative here. Indeed, I'm trying to be very positive, because my final practical results is to keep you trading, to keep ourselves trading as much as possible. Okay, and particularly if you're starting, as long as you learn the game as well. So I have gains resulting from correct price market assessment with first and active risk management after. It's not about trying to generate a 10% gain. It's about generating a 1 to 3 unit of risk based on how much you risk. And this could be 1%, could be less, could be more. I typically like this for reasons that I explain in step 5. Now, it's not about generating this, it's about generating this very often and by having a small risk. Because when we were able to do that and we are consistent, and there are some measures that we will see later on, then we can use other techniques in trading. It's not all about price and methods and setups. The other techniques like money management, very important. The psychology of trading, trading system development and actually looking at more markets, or looking at markets in smaller time frames. Okay. And we have no control on the market, so that's one of the other truths about the market. The market can do anything, and every outcome must be identified and accepted before even entering. Probably some of you have heard that the famous sentence that trading is a battle, or it's a war that you win before even starting it. Right, and that's the whole meaning of it, that we don't have control on the market, so every outcome has to be considered and accepted before the fact. And those outcomes include losing money. A lot of people don't even entertain that possibility. So you have to prefer low risk and steady gains in a longer period to a smaller amount of trades with large gains. A lot of people, want to have large gains very, very quickly. In order to do that, you have to risk a lot. If you risk a lot, you expose yourself to black zone. And so that's not smart, and honestly, it's not the way to go, because if you do this, we bring back trading to gambling. Okay. Now, if we want to gamble, let's go to the casino. Okay, let's not call it trading. Trading is something different. In fact, the main difference between trading and gamble, let me tell you what it is. And the difference between trading and gambling is that gambling is a game with expectation, negative expectation. Trading is a game with a positive expectancy. Okay, so if you want to trade this and you want to make money quickly, you are actually reducing trading to gambling, in which case it's probably trading is probably not for you. If you want to use trading, which is a game with positive expectancy, because we have rules, money management rules, setups, and we can even unbundle and unwind a trade, something that you cannot do when you buy. When you put your money on the roulette number. So keep this in mind. Are we trading? Fine. If we are trading, let's treat trading for what it is. It's a trading. It's an activity and a game with positive expectancy. Okay. So remember always this. If there is one thing that I want you to take from this presentation, is risk management is job number one. All the rest is secondary. See, we don't even mention gains here. In fact, gains are a byproduct. If you don't understand this, you're not considering framing trading in the right way. You're not coming from a frame of mind where trading it's a business. It's about managing risk. It's a positive expectancy game, but rather you're coming from a frame of mind where trading is an activity to generate an income, which is as possible, which is going to substitute the salary. So forget that. Trading is about big gains. Forget that. It's about managing risk properly. And trading is actually a positive expectancy game. Is not a negative expectancy game. Okay, so I hope this is clear. Now, I like to keep these rules in mind at all times. Well, I don't have to at the moment because, I mean, they're so ingrained in me that I don't need even to think about them. I do them automatically. But some people disregard to protect their precious capital. They take discretionary position. They believe that the market will go in their direction. The reality is that if that doesn't happen, then they lose 20%, 30% of their account. They are not protecting their money. And when you don't protect your money, what happens is that you make an enough big number of mistakes, and your money goes to minus. You lose 90%, the game is over. You lose 80%, the game is over. You lose 70%, the game is over. Okay. And rule number 2, I always pick low-risk ideas. Now, how do you pick low-risk ideas? Well, there are a number of ways to trade only where other groups of traders are trading. For example, smart money, dump money, algorithms, and professionals. There are ways to identify those areas in advance. In fact, I'm going to show you how we do that in the next section. You heard about plan your trade and trade your plan, but you wouldn't believe how many people cannot just are not able to simply follow instructions, even when I give them, in my trading FibStalker trading signal service, I give the entry, I give the stop, and I give the profit. And what they do, they wait that the market goes in the direction of the trade, and then they enter. So they enter late, and they skew the whole picture. And then when the market comes back, they don't exit. They miscalculate the position. They trade one lot fixed, and so plan your trade and trade your plan. We always hear about it, but you wouldn't believe how many people are not able to do something as simple as that. Okay, even when you instruct them in detail. And finally, of course, this is in psychology, because 75% of trading is about that. All right.